I have been wanting to record this for months. We help clients at Bedrock find, vet, and buy rental real estate all over the country. But the thing that's different about us is we actually help them deal with it and deal with the accounting and the administrative and the LLCs and the property managers. Part of that is we prepare an annual report for every single client on every single property every single year. And I have these things coming across my desk nonstop. I review them, my team reviews them, and all the time I'm like, man, that thing is awesome. I do not think people fundamentally understand how awesome single-family residential is. People seem to think like, hey, single-family residential is like a rookie's game. I want something with higher returns. The truth is, single-family residential in the right markets in the country blows other stuff to pieces. And as a risk-adjusted return, it is incredibly strong because you can own it, you can control it, you can leverage it, you can control your time, you can control your financing. It's a really good asset. I'm going to present today an annual report for a piece of real estate where this client earned over 40%. I kid you not, 40% single-family residential 1-year buy and hold lease. It is an awesome risk-adjusted asset class. Join me. I'll walk you through all the math. I just think people give single-family a really bad rap, and it's actually an awesome asset class as long as you're investing in the right places and treating it like a business. And that's the secret. All right. I get these reports across my desk every single day. At Bedrock, we help people find, vet, and buy properties. The difference between us and most other companies is we know there's a lot of work on the back end, and so we help people deal with those properties. I've wanted to do this for a long time, and basically it's just walk you all through the type of returns I'm seeing in single-family residential. Now, my big company specializes in helping people find, vet, and buy good rentals. And I think single-family residential gets a bad rap because most people think that just because their market kind of sucks, every market kind of sucks, and that can't be further from the truth. We help people buy all over the country. And so this is an example of a property that we bought 6 years ago in Memphis, Tennessee. And I'm just going to walk you through how insane the returns are. This is a client of ours, and we're just going to walk through piece by piece. But I'm going to spoil it. We're just going to eat our dessert first. This client posted a 40% return this year. 40.51%. Now that's because single-family residential real estate in general is what I would call a burger asset, all right? It's not just one return. It's a whole bunch of little returns that stack on top of each other. And so let's go through the math on this investment for this client, and I'll try to help you see it the way we see it. We've helped clients buy, my team's helped clients buy like 5,000 houses. And this is an insane return. Like in the world of financial advice and retirement planning, if I could get anyone a 40% return, that's hitting 6 home runs, right? Like we hope the S&P will average 7-8%. And that's with all the volatility in the S&P. This client actually posted on this annual report this year 40.5%. And she didn't have to do any of the work. I just talked to this client. I just got a testimonial from this client the other day where she really talked about like her life has changed. She's had people pass away. And the whole time, for the 6 years we've worked with her, we've taken care of the day-to-day. She hasn't had to deal with this property because that's what Bedrock does. We helped her find, vet, and buy it, and then we deal with the day-to-day. And so let's look at this return. But 40% is insane. Let's just help you see how she got there and what the real math behind a good piece of single-family residential looks like, so that if you're ever in the market and say, hey, I want to build a real estate portfolio, you'll at least know what to look for. And if you want Bedrock to help you out, happy to do it. All right, so let's zoom out a little bit. So the client bought this property 6 years ago, and I know what you're saying. Well, 6 years ago is a lot better real estate market than it is right now. Bullcrap. Right now is a great real estate market. It's a buyer's market if there's ever been a buyer's market. We're seeing that prices are softening across the board since October of 2022, when interest rates hit 7-8%. So as I look at this property, I'm saying, hey, this is actually a really good market to buy in. It was a great market to buy in 6 years ago. So what we did here is we found this property, $235,000. She bought the property for $61,000 out of pocket. One of the best things about real estate is that you can actually buy the asset 80-20 or 75-25. You can't do that with an annuity. You can't do that with gold. You can't do that with a mutual fund, right? Like you can buy on margin in the market, but everyone in the entire industry is going to be like, that's hyper dangerous. Because the truth is, if the values drop, you get margin called and you get liquidated out of your positions, you can lose everything really fast. It just takes the risk through the roof. So with that being the case, you could buy every piece of investment real estate leveraged 80-20, 75-25. It's unique that way. You can't buy gold 80-20. And so because of the financial instruments that are in the market, you can do things with real estate that you can't do with other stuff. And other people would be like, well, I like multifamily. You don't get a 30-year fixed mortgage on multifamily. You get a 7-year rolling commercial note on multifamily 95% of the time. With that being the case, this client only had to come out of pocket with 61 grand. Now that is going to be a really important thing to understand for this entire conversation. Her total property investment was 61 grand. Now, for those eagle-eye viewers out there who are like, why did you put 61 down on 235? That's a strange percentage. It's because we helped her find, vet, and buy the property, so she paid us $5,500. And there are closing fees attached when you buy a piece of property. So you're never going to put exactly 20% down. It's 20% down plus the closing fees on the property. Plus, if you use a firm like us, you'll pay us for our expertise because we know how to find properties like this. And I don't work for free. You shouldn't either. So with that being the case, she put down 61 grand. As of today, our estimated value says the house is worth about 309 grand. Now, we don't run a formal appraisal every year at Bedrock because depending on the market, that can run between like $300 to $600 a year, depending on the market. We just use Zillow and Redfin and I think Realtor.com right now. We just take an average of the three because what we want is a general idea until the year we go to sell it. We'll get it appraised when we go to sell it. We'll get some CMAs when we go to sell it. But 309 is just the average of the publicly available, easy to get data set. If you ever work with Bedrock, we're very systems people. We want it to happen behind the scenes. We want as much possible to happen with computers. That's how we keep our management fees low, our business management fees low. So with that being the case, she's gotten about $12,000 of appreciation a year on average for the time that she's held the property. All right, so when you take that, let's go to the actual cash flow on the asset. If you zoom out, you can see that this client has rented this house not for the moon. This is not an unfindable asset class. Like it's rented for $1,835 a month, and then the rent went up when the lease renewed to $1,870 a month. And so really like $1,870 a month off a $235,000 investment, if you followed along the channel for any amount of time, just divide it out. You say $235,000 divided by $1,870 a month. That's a GRM of 125. Now the 1% rule, which is the standard in real estate, would be 100. The lower the better. We tell our clients don't buy anything over 160. All right, I'm happy buying at 125. That's a smoking deal. But I won't buy anything over 160. If you don't know why, go watch a webinar where I talk about that. Not the point today. So with that being the case, 125 GRM, that's a really good bread and butter house. As you notice, it's a 3-bedroom, 2-bath, 4-bedroom, 2-bath, 1980s or newer build. It's a brick house, 2-car garages. We're not going to hold on to this property forever. We're actually, I think we're in the process of getting this either listed or when the lease finishes, we'll get it listed because we don't want to deplete the housing inventory forever. We understand there are problems in that. Also, we don't want to hold on to a property forever. Deferred maintenance, things getting older, things getting expensive, that's eventually going to get you. And so if you look at this property, she's bringing in $1,870 a month. That gives us gross rent of $22,000. Now, she owns this property with a mortgage. The biggest dog at the bowl is always going to be that mortgage. And so what we want to make sure you're seeing to understand real estate correctly is that mortgage actually changed this year. Now, you might say, why would a mortgage change? It's 30 years fixed. It is and it isn't. The mortgage payment's a 30-year fixed. The interest payment is 30 years fixed. The property taxes change. The homeowner's insurance change. And most of the time those are escrowed. They're combined into the payment. What we have found is one of the many things that Bedrock does on our business management side is that this can be its own obnoxious. Because a lot of our clients would, in the history, we didn't always manage the business side of this. For years, our team just helped people buy houses, and they dealt with them. But what we saw is there were just all these little business management issues that would pop up, and they would be a huge dang hassle. The escrow account changing yearly is one of these enormous hassles. Because what happens is people would go in and they would put their bill pay on monthly from their account. They're just like, okay, the rent's coming in, it's $1,800, I've got to send $1,298 across to my mortgage. They would just set it up on bill pay. And at some point, they'd be on vacation or doing something else, not paying attention to it. A letter comes in and says, hey, next month your payments jump into 1331 because your property taxes went up a little bit, because your property went up in value, and because your homeowner's insurance went up a little bit, because homeowner's insurance nationwide has been going up insanely, just by a lot. My client, if they were just sitting it on bill pay, would send in a payment for $12.98 because it goes out automatically. The bank is expecting to receive a check for $13.31, and we had to unwind a bunch of these in the early days of Bedrock because it's just a problem that happened a lot. And so what happens is the $12.98 goes into what's called a suspense account or a holding account or some like phantom zone of money. And what happened is they wouldn't cash it. They would just go into some phantom zone of money and it would just sit there. And the mortgage would go late, 30 days, right? And then they would automatically just send out another bill pay, and the client would think, hey, I'm paying my bills, it's all on bill pay, it's all taken care of. But the actual bank wouldn't be cashing those. And so another payment would go late, and they would get a notice from their bank saying, hey, you're 60 days late, we've had to report on your credit. And so all of a sudden they've got a negative report on their credit, on a mortgage, on a major asset, and they call us out of the blue because back then we didn't offer the business management piece of the company, like, hey, what do I do? And we would have to explain, like, okay, you need to call your bank. You need to see if there was an escrow increase. My guess is you missed a letter, right? And if there was an escrow increase, they've put your $1,298 a month into some phantom account or some holding or suspense account. You need to get them to credit that to your principal, and then you need to see if you can beg them to withdraw the negative credit from your report, which they're not going to do. So unfortunately, you have a 25-point lower credit report for the next 4 years because of this mistake. We saw that a lot. Now, just as a investor tip, if you set up your bill pay through the mortgage company, so if the mortgage is through Coldwell Banker, if you go onto Coldwell Banker's site and set up the bill pay as an auto draft, if the escrow increases, it will draft the correct amount. Now, if they ever double or triple draft your account, you're going to end up with problems of a different sort. And the truth is, single family residential, we call it a noisy asset, right? It's insane returns, 40% insane returns. But anyone who's like, hey, we just hire a property manager, they'll take care of everything, that's some bull freaking crap. It is not true. Not true, never going to be true. This is just one little nuance, one line item. And I was trying to give you guys like the basics of this 40% return, which looks freaking awesome. But the truth is, there's all this nuance that goes into managing it and all these landmines that you can run into that can cost a lot of hassle. I think the times we had to unwind this for a client and they paid us, took us 5-6 hours a pop. And that's us who like know how to do this. And so eventually we just launched a business management service where we just take care of all this and charge a lot less. And most of our clients use that, and most of our clients are insanely happy. But that's just one nuance. So you'll notice that the mortgage went up. Homeowners insurance, escrow payments, that does happen. But you'll notice the mortgage went up. Out of $22,000 gross total revenue, they had $13,000 on the mortgage, right? Cool. Very, very straightforward. This client, we got way back in the day before we adjusted any fees. This client, we charged $700 last year for everything we're talking about. That's so low. So low. They got the deal of a lifetime. It's a little bit more than that now, but they signed up with us when we renew, and we've never raised rates on an existing client. And so they only had to pay $700 for all the work I'm going to describe and the annual report. That's crazy. Standard fee this now is like $1,200 for this style contract. And so, yeah, the fees go up. But yeah, they paid us $700 to do all the day-to-day, set up their LLC, run their LLC, set up their accounting and administrative, do their bookkeeping, get them ready for tax season, send them tax-ready documents, P&Ls, and balance sheets. Their accountant's going to read everything a little differently, so their accountant's going to call us expert advice. Hey, here's this. Oh, we need the HUD to calculate your depreciation. Here's a HUD. Like, yeah, we paid $700 and to deal with our property manager. Now, this one's in Memphis. I love our Memphis property manager, but we have 13 property managers in 7 states. We tell our clients property managers are great as long as they can be watched like a rat in a cage. Some are terrible, and some are really good. Like this property manager is really good, but last year he had some family stuff that happened and got really questionable, and he tore a thing in his arm, and got really questionable. And we've had property managers that have been great for 10 years, and Mary leaves, the lady we talked to at their office, and we're like, yeah, they know what they're doing. And then Mary goes and gets another job, and it all goes to hell overnight. And we're like, oh, wait, the property manager's not good at this. Mary was good at this, and Mary's gone. And now we're dealing with all this bullcrap and blowback that if we hadn't been aware of keeping the property manager honest, and if we hadn't been really aware of how a property manager should work, we would have let this relationship go way down, have way more blowback, maybe have some horrid evictions. Like, property managers are great as long as they're watched like a rat in a cage. All right. And so you can see the property manager, they're getting paid their, I think it's 8% in Tennessee. They get their piece, $150 a month on average. Not the end of the world. $150 a month to do all the work they do is good money. And then we have normal repairs and maintenance, $1,650. I think on this house we had to replace the garage door opener, the thing on the top of the garage that opens and closes it. I think that was $1,600. It could be, and I'm not looking at my notes on this one, it also could be an AC compressor. We had to do an AC service. I'll look that up. But, some major repairs. We at Bedrock factor 10% of gross rent every year is going to go out the door in vacancy and repairs. We expect $2,200 to get spent on this property in vacancy and repairs. This year we came in low. Now, a vacancy year, it's going to be higher than that, but we say, hey, at least 10%. If you're running your own real estate and you're not factoring some for vacancy and repairs, 10 to 15%, depending on if you have a mortgage or not, you're just going to get burned. I worked with someone the other day who worked with another turnkey house and bought a property out in Oklahoma, and on their pro forma, it was like negative 2%. And so I said, so if everything goes perfect, you're still going to lose money. And they're like, uh-huh. I'm like, that's horrible because nothing's going to go perfect, right? So we just say, hey, let's just assume this thing is going to cost us $2,200 a year to keep running. If it's less, great, we can make more money for a year. If it's worse, great, hopefully we have enough margin. So it's really important to keep an eye on those things. And then we get to operating income per month, and you can see per month after all the expenses, it varies. It varies depending on when the money comes in and when the money doesn't come in. And I think this client had a late payment twice last year, and they made those payments, they caught up on those payments. And so it was a typical landlord-tenant relationship. I'm pretty sure this property, we had to be on the call with the property manager. We almost had to go into eviction with this tenant. They had some things happen in their life, and we had to work with them a little bit. But you saw they got caught up. At the end of the day, we had a good tenant relationship. And at the end of the day, we took $22,000 of revenue in. We spent all but $4,300. Now, that is the next really important number. All right, if you take this all to the top right of this form, and you might be like, Jeremy, what am I looking at? This is an annual report for Bedrock. We do this for every single client on every single property every single year because there's a lot going into this behind the scenes. Like, we're pulling down data from Zillow, Redfin, Trulia. That data APIs in or doesn't. They change their API code so we can or can't. So we've got to go and make sure that data is available when we pull an annual report. This data right here comes from a couple different sources. The rent comes from the property management statement. The Bedrock admin fees comes from the bank account level. Legal services come from the bank account level. Property managers don't pay for legal services. Mortgage payments comes from the bank account level, the LLC level. Property management fees, that comes from the property management statement. I'm going to put property management there. The rest are from the bank. And then repairs and expenses, that can come from the LLC, that can come from the property manager, just depending on if you wrote a check for that or if they just withheld. And this is a simple statement. So this stuff is all coming from online to give us valuations. This stuff is coming from some historical database where we track how much was the purchase price, how much did you put down, how much is it worth. It's referencing some stuff online, some APIs and some data entry. This stuff is the property management statements. Again, we got 13 property managers in 9 states. Each property management uses their own software. We must have at least 9 property management softwares. Appfolio at least reports out income delineated. You can at least just pull Appfolio into QuickBooks. There are some that come out of Florida that look like a dang ransom note. For some reason, they break everything into a fractional piece. Like, they'll take in $1,200 and they'll spread that $1,200 over 12 months at $100 a month, which automatically is bonkers because it was revenue in 1 month, not revenue spread over 12 months. But then every expense will also get that treatment. They'll spend $120 on like a faucet, and their software will break it into a 1/12 expenditure over 12 months. And so you're just going to have to hand that ransom statement to your accountant, and he's going to have to go make sense of it at $150 to $450 an hour. And so all that stuff has to get done. We just do it all internally. So you can see there's just a lot of pieces that go into even building an annual report. We build one of these, actually build 4 of these for every client every year on every property, because since we offer a business management service, we're already taking those property management statements and getting them into QuickBooks for them. Some of those API in, it's simple. Some of them we have to do manual data entry. I have a guy full-time who reads those ransom note statements and knows how to import those into data. And then we oversee the property managers and their work to make sure that this $1,650 air compressor is not like getting gouged. You wouldn't believe the number of property management statements we've seen that has like replace light bulb $150. So there's all this stuff that goes into these property management statements. That's what you're looking at. You're looking at a property management statement that we prepare for our clients. So let's go to returns, because that's probably what you're most interested in. If we go to returns and really dial down and try to understand what happened on this client, everything that's going to matter is off of this number right here, $61,779, because that's how much this client had to put out to own it. All the returns, return on investment, the investment part, very important, all right? 67 grand. And then we have reserves in a bank account for the client. We manage those reserves. We make sure those reserves are healthy. We make sure if there's excess expenditures, their bank account's being managed well and the money's not disappearing, all that good stuff, right? So with that being the case, their total income, 22 grand, their total expenses, 17 grand. That means their cash on cash or net operating income was $4,352. Now that whole thing is going to get divided by 66,177 bucks. That's what this client had to put up to get this property. After all the bills were paid, after we were paid, property managers were paid, repairs were done, all the rent came in, the evictions almost happened, the evictions didn't happen, we caught up with the tenant. After all that was done, they had $4,300 profit. That $4,300 divides into their total property investment, which includes our fee and closing costs and everything. A lot of pro formas that I see from other competitors, they'll just say down payment without taking into effect that there's another 10 or 15% of costs in there. You're going to pay them. They're not doing work for free. You know, you're going to pay closing costs for them too. No one's magic. We're not getting attorneys to work for free. And so you've got to make sure that this number, if you're looking at any pro forma, is reflective of their fees and closing costs. All right, we take net operating income, we divide it by $61,000, and you can see 7% cash on cash, net operating income. Now, one of the unique things about Bedrock is we hate when our competitors sell garbage properties and then walk away. We think it gives the industry a bad reputation. We think it leaves a horrible taste in everyone's mouth. And financial advisors just see that and they're like, don't buy property where you don't live. It can go horribly wrong. And as someone who was in that business for a decade and advised on like $300 million, I agree. We actually offer a contract that says if we don't get you at least a 4% cash on cash return, we'll do all the work that I've talked about in this video, but we'll do it for free. I'll pay my people out of my own pocket. Are there times when I have to pay my own people out of my own pocket? Yes. If this property had had a vacancy, our operating margin here, our room for error was $4,300. That's a 3-month vacancy, right? Because you have to pay the mortgage. And so I could, on this property, end up in a position where I have to pay my people out of my own pocket. I understand that is the risk we're taking for our clients. If they are feeling pain, I am feeling pain. I would never, ever send something out the door that I thought was going to be a problem, because it's going to be my problem, because we offer a business management service. We do the day-to-day. So 7%, I get paid, they get paid. Woohoo! All right. Number 2, if you have a mortgage on your property, which they have, in year 1, you paid on 1.48% of the balance of the mortgage in year 1. And that percent creeps up. It goes like 1.48 to 1.5 to 1.5 to whatever. We've got the math built into our stuff. But we know beyond a shadow of a doubt that we paid off $30 or $200 of the mortgage. Now, that's kind of forced savings, right? You're not going to see that money until you sell the house. But it is abso-freaking-lutely return. Right? You are richer $3,200. The fact that it's equity on a house does not bother me whatsoever. So we got to count that. We got to say, okay, we know how much the principal got paid down on the mortgage. We know how much less in debt we are. And we know if we take that $3,200 and divide it into our investment, $61,000, we know that comes out to an additional 5% return. Single-family residential is a burger asset. All right, there's the cash flow, but there's also the principal pay down. There's also the appreciation. There's also the depreciation. And all of those are different, and they come into the equation at different points in the conversation. We just put them all together in one place so you can see them. And we're not like, hey, this is the way you have to interpret it. You can say, okay, I got 7% cash on cash, but you're richer 40%. So let's go through the rest. So you've got your principal pay down, $3,000, 5%. You've got your cash on cash, net operating income, 7%. Awesome. And then you have your appreciation. Now this client bought for $235. It's now worth roughly $309. We just take that, we put it up, we divide it by 6. Annualized appreciation, I don't really care when that happened. It's happened, and I think we just listed the house for $320. It's better than that. But $74,000 divided by 6, that gives us an annualized appreciation number I can live with for this year. $12,000. Again, you take $12,000. That's the $74,000 divided by the 6-year hold time. You say, hey, we're going to take that, divide it by our $61,000 total property investment, and that's going to give us a whopping 20% return off of a single year. That's the reason you want leveraged. If you want leveraged, that's the reason. Because you put in not that much money, but you still get to hold the entire appreciation. The bank is taking the risk on 80% of the funds here, but they are getting to hold on to 100% of the appreciation. Now, it's a higher risk product than cash, but I love leveraged real estate. I think leveraged real estate is the same. And so that is really, really strong. And then the last piece of the equation, and this is kind of more an accountant conversation, but the IRS knows that a house will wear out eventually. The IRS knows that you will eventually have to replace everything. You'll eventually have to replace the roof. You'll eventually have to replace the brick. You'll eventually have to replace the water heater. You'll eventually have to replace the AC. Every piece of the house will eventually wear out. In the IRS's grand and universal wisdom, that is going to happen in 27 and a half years. And so what they let you do is they let you take the depreciable value, 127 and a half per year. Now, that's not the whole value. This client bought for $235. You're able to use 80% of that, because what the IRS is going to say is you can't depreciate land. Now, if you can't depreciate land, that means you can't depreciate $235. Some of that represents land. And so the way that the depreciation works, not an accountant, just a guy who's done a whole bunch of this, you go $235,000 times 0.8, 80%. You say, I've got $188,000. That represents the house, not the land. And then I'm going to divide that by 27 and a half, because they'll let me write off 127 and a half per year. And so I'm going to go back to my calculator. They're going to let me say that I had expenses that I haven't paid yet, that I have unrealized expenses, that the house wore out to the tune of $6,836. All right, when IRS time comes, they're going to say, hey, the house is a year older, my roof is a year older, my water heater's a year older, everything's a year older. Eventually, I'm going to have to spend $4,000 on a new AC. It wasn't all profit because the house is a year older. It depreciated in value. And how do they get to depreciation? You take your depreciable value, 80% of your purchase price, you divide it by 27 and a half, and that's your depreciable value. And so you're allowed to tell the IRS, I actually lost $6,800 on this thing. It's a deduction, right? Take that right off the old income. And you'll notice I only had $4,000 of income, so, it was actually cash flow negative. Oh, I lost money on this whole deal. This is why rich people just get richer and richer, because the tax codes are written so that they can just exploit and exploit and exploit. And the longer the republic stands and the more rich people have the ability to government capture and twist the tax codes, the more stuff like this is going to happen. On paper, they actually lost money. They're $4,300 richer. They're $75,000 richer because of appreciation. But as taxes go, none of those things are realized. It's just showing a $6,800 loss because of depreciation. And so what we say is we're going to assume our clients are in the 25% tax bracket. And so we're going to assume they realized a tax savings, about $1,700, another 2.77%, right? Because they did get a tax savings. I don't know what their tax bracket is. A lot of ours are in the higher end, but we say 25% because I think that's a very real tax savings for anybody. And so you add all that up. That's how my client just got a 40.5% return, because their real estate cash flow positive. They had a little bit of principal pay down. They had a little bit of appreciation spread over 6 years. They had a little bit of depreciation. Bob's your uncle. That asset kicks the ever-living crap out of any other asset almost on the market. The risk-adjusted return of single-family residential is insane. And while I was doing financial advice for a decade, advising on like $300 million, I realized that single-family residential is actually hyper strong in the right markets. And that's the caveat that matters. You can't just invest in your backyard. It probably sucks. Memphis is one of the 7 markets we're currently buying in, and we're always changing markets. We're investing right now in Oklahoma City. 5 years ago, we were investing in Indianapolis. We're not investing there anymore. And so you've got to really be on your toes and able to buy where the numbers make sense and where the returns are really good for real estate to make sense. Now, what we also do, which is just cool, and it's just because we have the data, because I like over-delivering a little bit when it comes to promises and expectations, we also do this report. I don't think humans do a really good job of seeing, well, what if I had taken the road not taken? So this is an alternative report on the same exact property, and all we're showing here is what if you had bought it cash. That other report is saying, hey, it's leverage. That's what my client did. But this report is saying, well, what if I hadn't bought it leveraged? Well, number one, for a $235,000 house, I would have spent $250,000. I wouldn't have been able to get into it for $61,000. But if I wouldn't have done that, all the rest of the numbers would have been the same. You would have had the same tenant. That tenant would have maybe almost got evicted twice. The expenses would have been virtually identical. The only thing that really changes is the mortgage would have gone away. And so we wouldn't have had to deal with the mortgage, wouldn't have had to deal with the mortgage changing. So what we do is we just strike that out and rerun the report so that our clients can see, hey, what is better for me? Do I want cash real estate? Do I want leveraged real estate? Everything else in the entire report, identical. Now, if you owned your own real estate, have you ever once gone in and been like, I wonder if I would have been better off if I bought this cash, or I wonder if I would have been better off if I bought this leverage? Probably not. One of my best friends in the world is independently wealthy. He's bought real estate his entire life. I buy real estate for other people. He's bought his own little portfolio. He's very, very happy. But we have these conversations. He's like, I would never do that, man. I would never spend the time it takes to get an annual report. Like, is there more cash in my bank account than there was last year? And so he runs it all in cash. He would love a report like this, but it just doesn't make sense for him to create this report. Since we're doing it for investors, and again, systems, we've really dialed this in so it doesn't take much time, right? We have all the data feeding into the hopper. We're tracking it all for every single client every single year. It's a good conversation piece for me to have with every single client every single year. And I wanted to be able to say, hey, you're getting older. Is your goal to have the highest return possible? Or is your goal to have more cash flow? Because a lot of times in retirement, we'll advise, hey, sell these two and consolidate them into one. Because a lot of people would be better off not with a higher return, they'd be better off with a lot more income. And so you take the same exact math, $22,000 in cash. You take out all those expenses, you eliminate the mortgage, and what you can see is that we end up with total expenses of $4,700, total income of $17,000, or a 7% return cash on cash. Now that's off of $250K. What you lose in this example is there is no mortgage, so there is no principal pay down. Here you were at $4,000 after all the expenses. Now you're at 17. You got much better living income now. You've got your cash on cash, 7%. There's no principal pay down on that. And then you have the same appreciation, $74,000 appreciation spread over 6 years. So your annualized appreciation is the same. But that $12,000 of appreciation now divides into 250 grand because you didn't put in only 61 grand. You put in 250. You own the thing cash. So you're dividing it by a much larger number. You're dividing it by 250, not 61. And so what you see is the return here was 20%. Now it's 5%. Still good, still respectable. And you get to write off the same exact amount of depreciation. It's still the same house, still the same valuation, still the same depreciable amount, still the same IRS codes, but $1,700 in tax savings feels different divided against 250 grand versus 61 grand. Now, this client owns the same asset, but instead of getting 40% return, she got 11% return. And just between you and me, that still kicks the crap out of any annuity in the land. That still kicks the crap out of any bank on yourself plan or most stock market plans or mutual funds or indexed funds. If I could have $17,000 kicking out every single year with pretty high probability and really low risk of like, how many times has the market crashed by more than 30%? 10 times in the last 100 years, right? How many times has real estate gone down by 30% in a single year? Once. Oh, wait. Right? You're never going to have the same level of volatility in this that you're going to have in other major asset classes. Even if she owned it cash, it would still be pound for pound with the S&P, which I think is insane. And other people put all their money in annuities. I don't think annuities are evil. I actually like annuities for their purpose. But I think a cash flow piece of real estate kicks the ever-living crap out of annuity, game, set, match, all day, every day. And you don't have to take an insane amount of risk. And you don't have to spin down the asset. So this is an awesome report that we do. We do this for every single client, every single year. We pull all the data together, we talk it over with our clients, we make sure they don't have any questions, and then we update it as part of our LLC Minute package so that their LLC is in compliance no matter what state they're in. And so this is something we see. I see this every day. I'm going to do a lot more of these. I'll try to keep them shorter. But this is an annual report for a single client of ours who bought a property 6 years ago. They just posted a 40% return is what they're posting this year. That's dang madness. And that's what we do. That's what we're helping people do. All right, if you stayed this long and you're interested in talking residential and you're open to the idea that single-family residential is actually way strong, the next video I would watch is Don't Buy Real Estate Here. And I break down using my most common metric, what makes a good market, what makes a bad market, how to spot it really quickly, and how to see like, hey, if Bedrock's buying over 5,000 houses, how are they finding deals that make sense? Because maybe in my backyard, they suck. Don't buy real estate here. I'm going to put it right here. Thank you so much. Have a good day. Bye-bye.